Oil and gold are devils or angels for traders. Hey everyone, and welcome back to Market Meridian. If you've been trading anywhere near the commodity space over the past few months, you already know the feeling. One day you're riding a strong trend, feeling like you've cracked the code of the market, and the next day a single headline slams your position into a stop loss before you even have time to react. In today's global financial system, two assets stand above everything else in their ability to inspire both extreme hope and extreme fear. I'm talking, of course, about crude oil and gold. To some, they are guardian angels, reliable stores of value, powerful hedges against inflation, and safe havens when the world feels like it's falling apart. To others, they are ruthless devils, capable of wiping out accounts in hours, distorting technical levels, and turning even the most disciplined traders into emotional gamblers. Today, we are going to settle this debate once and for all. We're going to break down why crude oil and gold behave like angels for some traders and devils for others. We'll dive into their structural differences, their reaction to geopolitics, their relationship with central bank policy, and most importantly, we'll lay out the exact skills you need to master so you can trade them consistently without getting destroyed by volatility. By the end of this video, you won't just have a better view of oil and gold. You'll have a complete trading framework that separates amateurs from professionals in the commodity space. This is Market Meridian, and this is your complete guide to understanding crude oil and gold in today's chaotic market environment. Introduction: the two icons of market fear and greed. Let's start with a simple but powerful truth: crude oil and gold are not just commodities. They are symbols. Gold is the oldest form of money humanity has ever trusted. For thousands of years, across every civilization, gold has represented stability, permanence, and security. When empires fall, when currencies collapse, when wars break out, gold remains. It is the ultimate financial insurance policy. Crude oil, on the other hand, is the lifeblood of the modern economy. It powers factories, transportation, agriculture, militaries, and entire supply chains. Without oil, the global economy stops. That's why oil is not just a product, it's a weapon, a political tool, and a leading indicator of global growth and inflation. Together, these two assets form a dual force that dominates every serious trader's watch list. And in the current environment, one defined by sticky inflation, shifting central bank policies, ongoing geopolitical conflicts, supply chain restructuring, and extreme liquidity conditions, their movements have never been more important or more dangerous. So let's answer the question directly. Are crude oil and gold angels, or are they devils? The answer is, they are both. And which one they become for you depends entirely on your knowledge, your strategy, your risk management, and your ability to interpret what the market is really telling you. If you trade them blindly, chase momentum without context, use excessive leverage, or ignore macro fundamentals, they will act as devils. They will punish overconfidence, exploit impatience, and erase capital with brutal efficiency. But if you understand their drivers, respect their volatility, filter out noise, and manage risk like a professional, they become angels. They offer incredible trading opportunities, strong trend structure, and reliable hedging characteristics that no other asset class can match. Today, we are going to make sure you experience them as angels, not devils. Crude oil, the king of commodities. Let's begin with crude oil, widely known as the king of commodities. If you've ever traded oil, you already know it can feel like a roller coaster without seatbelts. Let's break down its devilish side first, then its angelic qualities, so you understand the full picture. Why crude oil can be a devil. First, the devilish characteristics of crude oil. Number 1, extreme and unpredictable volatility driven by geopolitics. Unlike stocks, which mostly rely on earnings, revenue, and company guidance, oil is controlled by forces that are almost impossible to model with technical analysis alone. OPEC+ meetings, production cuts, political negotiations, pipeline disruptions, shipping attacks, war risks, and diplomatic tensions can all trigger massive, overnight price swings. One day, the market is pricing in a slowdown in global demand. The next day, a single threat to shipping lanes in the Strait of Hormuz can send prices soaring 3% to 5% in minutes. For traders who rely purely on support and resistance levels, this is catastrophic. Technical levels break without warning. Patterns fail. Stop losses get hunted aggressively. And number 2, it is highly sensitive to headline risk. In today's world of 24-hour news cycles and social media speculation, crude oil reacts to every single rumor. A single unverified tweet about potential production increases or regional conflict can create false breakouts and fake breakdowns. Amateurs buy the top and sell the bottom, getting chopped to pieces. And number 3, leverage amplifies its destructive power. Most retail traders access oil through futures, CFDs, or leveraged ETFs. Even a small against you move can lead to devastating losses if position size is not adjusted properly. What makes oil particularly cruel is that it often moves fast and then reverses even faster, trapping traders on both sides. If you are not prepared for this level of unpredictability, crude oil will act like a devil, systematically destroying your trading account. Why crude oil is an angel for skilled traders. Now, let's talk about why crude oil is an angel for traders who know what they're doing. First, oil offers extreme liquidity. You can enter and exit large positions without significant slippage. For active traders, liquidity is oxygen, and crude oil provides it in abundance. Second, oil is a fantastic macroeconomic indicator. It rises when inflation expectations rise, when global growth is strong, and when supply is constrained. It falls when demand weakens, when recessions are priced in, or when political tensions ease. This makes oil an excellent tool for trading macro themes. Third, volatility itself is a trader's best friend, as long as you manage risk. Most investors hate volatility. Traders love it, because volatility creates opportunity. Crude oil gives consistent, tradable moves. When you understand the drivers behind the moves, you don't just gamble, you execute high-probability setups. Fourth, oil acts as a powerful inflation hedge. When central banks print money, when input costs rise, when energy prices push consumer prices higher, oil tends to outperform. For anyone looking to protect their portfolio from currency devaluation, oil is a strong weapon. Today's unique environment for crude oil right now, crude oil is trading under a unique structure. We are no longer in a purely supply and demand market. Geopolitical risk premium has become the dominant driver. Conflicts in key energy-producing regions, threats to global shipping, strategic production decisions by major oil nations, and the restructuring of global energy trade flows have all created a market where a safety premium matters more than inventory reports. This means that trading oil today requires you to think beyond traditional fundamentals. You must understand geopolitical risk, policy timing, and market psychology. If you can do that, crude oil shifts from a devil to a consistent source of profits. Gold, the ultimate safe haven. Now let's shift our focus to gold, the most revered and misunderstood asset in the world. Gold is unique because it is simultaneously a commodity, a currency, and a safe haven asset. It doesn't corrode. It doesn't disappear. It cannot be printed out of thin air by governments. That's why it has survived as a store of value for thousands of years. Again, let's split its personality into angels and devils. Why gold is an angel? First, the angel side of gold. Number 1, it is the ultimate safe haven asset when uncertainty rises, when wars break out, when banking systems come under stress, when faith in fiat money weakens, capital flows into gold. It is the ultimate flight to safety asset. Number 2, gold is a historic hedge against inflation and currency devaluation. When central banks maintain low interest rates, expand balance sheets, or allow currency to weaken, gold preserves purchasing power. In environments where real interest rates turn negative, gold historically performs extremely well. Number 3, central banks are buying gold at record levels. Over the past several years, global central banks have been accumulating gold at a historic pace, moving away from over-reliance on the US dollar. This structural demand creates a strong floor under gold prices. And number 4, gold is becoming an anti-fiat currency. In the past, gold mainly moved inversely to real yields and the US dollar. Today, amid rising geopolitical fragmentation, gold is gaining independent value. It is no longer just a reaction to Fed policy, it is becoming an alternative monetary asset altogether. This is a massive shift. For traders who recognize it, gold offers once-in-a-decade opportunities. Why gold can also be a devil, but gold can be a devil too, especially for unprepared traders. And number 1, gold does not produce yield. Unlike bonds, dividend stocks, or real estate, gold pays no interest, no dividends, no cash flow. That means if you buy gold at the wrong time, you not only face price drawdowns but also opportunity costs. You could be missing out on high-income assets while waiting for gold to move. Number 2, gold is prone to fake breakouts and aggressive washouts. Around major economic events, non-farm payrolls, CPI readings, Fed meetings, gold often experiences violent whipsaws. The market hunts liquidity, runs stops above and below key levels, and then reverses sharply. Many traders get stopped out right before the real trend begins. And number 3, gold can stay range-bound for long periods. If you are a short-term trader, waiting for gold to break out can feel like watching paint dry. And when it finally moves, it often does so suddenly, leaving slow traders behind. Number 4, sentiment can shift extremely fast. 1 week, everyone is bullish on gold because of geopolitical tensions. The next week, strong economic data or hawkish Fed commentary can trigger a sharp sell-off. If you are overly leveraged, this can be fatal. So gold, like oil, is a double-edged sword. It rewards patience, discipline, and macro awareness, but punishes greed, over-leverage, and emotional decision-making. The 3 core skills you must master. Now we arrive at the most important part of today's discussion, the skills that separate traders who get destroyed by oil and gold from traders who profit consistently. These are not complicated theories. They are practical, actionable skills you can start applying tomorrow. Skill 1, macro synthesis, the ability to connect the dots. The first skill is macro synthesis. This means you do not look at a chart in isolation. You look at the entire global picture. For crude oil, you must monitor OPEC Plus policy and production decisions, global shipping and logistics risks, refining margins and crack spreads, inventory dynamics, geopolitical tensions in oil-producing regions. For gold, you must track U.S. 10-year real yields, U.S. dollar index, DXY, central bank buying activity, inflation expectations, geopolitical uncertainty. Every morning before the market opens, ask yourself one simple question: is the current dominant narrative driven by growth fears, inflation fears, or geopolitical fear? Once you know the main driver, you can align your trades with the strongest force in the market. Amateurs trade the chart. Professionals trade the context. Skill 2. Dynamic position sizing and volatility adaptation. The second non-negotiable skill is dynamic position sizing. Oil and gold are highly volatile, which means your standard position size from stock trading will get you wrecked. You must adjust your position based on volatility, using tools like the ATR, average true range. When volatility expands, you reduce position size. When volatility contracts, you can increase size slightly while keeping your risk per trade consistent. Additionally, you must learn to scale into positions. Trying to pick exact tops and bottoms in commodities is a losing game. Entering in layers allows you to manage risk while participating in strong trends. Remember, in commodities, survival is more important than being right. You can be correct about the direction but still lose money if your size is too big. Skill 3, geopolitical noise filtering. The third skill is filtering geopolitical noise. This is what makes professional traders calm while everyone else panics. Not every headline matters. Most news is short-term emotional manipulation, not a long-term trend change. When a conflict or crisis makes headlines, watch how gold and oil react. If prices do not surge on supposedly bullish news, the market has already priced it in. Often, the trade becomes a fade, not a chase. Professional traders ask, is this news changing the long-term structure, or just creating short-term chaos? If it's just noise, they ignore it. If it's a structural shift, they position accordingly. And finally, embrace your stop loss. In commodity trading, stopping out is not failure. It is the cost of doing business. It is the ticket you pay to participate in the next high-probability setup. Traders who refuse to take stops end up giving back all their profits and then some. Chapter 4, Today's Practical Trading Playbook. Now let's turn this knowledge into a real-time trading playbook you can use immediately. First, watch correlation between oil and gold. Pay attention to the relationship between USO and GLD, or crude oil and spot gold directly. If crude oil rallies strongly but gold remains flat or weak, the market is pricing supply risks or inflationary pressure, not broad systemic fear. If both gold and oil rally hard at the same time, that indicates the market is pricing elevated geopolitical risk or a breakdown in financial stability, a true crisis regime. Understanding this divergence or convergence will help you avoid trading against the hidden macro current. Second, key levels to watch. While I do not provide specific personalized price targets, the framework remains universals. For crude oil, watch the key psychological and structural levels that define the current range. A daily close above a major resistance zone confirms a shift from sideways action to a breakout trend. A break below key support signals further downside. For gold, monitor the critical level that acts as the last defense for sellers. A clean break above that level often accelerates into a strong trend, but it also signals rising global uncertainty. Third, avoid the buy the rumor, sell the fact trap. One of the biggest mistakes traders make with oil and gold is buying into peak fear. When a geopolitical event dominates the headlines, the market has usually already priced in the worst-case scenario. Once the situation becomes clearer or de-escalates, even slightly, both gold and oil often experience sharp pullbacks. Traders who buy at the most emotional point typically get caught holding the bag. Stay patient. Let the market show its hand. Do not chase the crowd. Conclusion, angels or devils, you decide. As we wrap up today's deep dive, let's return to our central question, are crude oil and gold devils or angels? The truth is, they are reflections of you. If you trade with greed, without strategy, without risk control, and without understanding the macro landscape, they will destroy you. They will be devils, but if you approach them with discipline, patience, context awareness, and strong risk management, they become angels, powerful tools to grow your account, hedge your portfolio, and navigate even the most chaotic markets. Trading is not about being right all the time. It's about managing risk, controlling emotions, and aligning yourself with the strongest forces in the market. The day you stop asking, where will this go next, and start asking, what will I do if it breaks support or resistance, is the day you become a professional trader. The markets reward those who respect them. And in the case of crude oil and gold, respect means understanding their dual nature, adapting to their volatility, and staying disciplined when everyone else is panicking. Thank you for watching Market Meridian. As we head into another week of intense macro and geopolitical moves, stay focused, stay disciplined, and always protect your capital first. I'll see you in the next video, where we continue to decode the markets with clarity, logic, and professional insight.